And so I'll go ahead and get started. My name's Pete Knorr. I'm a vice president of Bogart Wealth. I'm obviously not this good-looking fellow on the cover page, but I'll get to me more in a minute. So today's topic is, how do the discount rates affect the ExxonMobil lump sum? If you're not with ExxonMobil, don't worry. Most of what I'm going to talk about is generic and applies to all companies that offer a lump sum for their pension. But in some places, I'm going to be very specific about ExxonMobil, and I'll try to remember to differentiate those things. First, a few words about Bogart Wealth. So in the financial advice universe, there are two groups of advisors. There's the ones who work for a bank, like that bank might be Merrill Lynch, Morgan Stanley, Wells Fargo, Chase, etc. And then there are the ones who are independent from many banks. And we like to think that's a lot better because we can report just to the clients. But then the clients say, well, who actually has custody of my money? So these registered investment advisors, which we are a registered investment advisor, we use institutional custodians. Like in our case, we use Charles Schwab. Another big one you've probably heard of is Fidelity. So you would have your money with a custodian, and you would give us a limited power of attorney to be able to represent you to that custodian. And what do I mean by that? Make buy and sell trades in your accounts and move money among accounts that are registered in your name. So as a registered investment advisor, we are legally obligated to be a fiduciary in all of our transactions with you. So what it basically means is we have to put your interest ahead of our own. If we have any conflict of interest, we have to disclose those conflicts of interest and provide a complete disclosure to you, and then always act in good faith, okay? Never misleading, blah, blah, blah. So that's a very important legal guarantee for you. This is our team. We're not a huge company, but we continue to grow. So on the top row are advisors, headed by the owner of the company, the principal, James Bogart. And you can see the rest of us lined out here. So who are all the rest of these? Well, we have a full-time portfolio management team, so that when I'm doing a webinar, somebody's still watching your accounts. So that's headed by Alex Spencer. We have a full-time financial planning team headed by Sandra. So we also have people who are always interacting with Schwab on your behalf to move money around, for example, open new accounts, change your beneficiaries, that sort of thing on your behalf. We also have a tax team, so that if you want us to do your taxes, we can do that. It can be a full service. We also do tax planning, tax optimization, those sorts of things. We have 3 locations. The company started out a couple of freeway exits north of Gallows Road in Fairfax, Virginia, if that means anything to you. And then when we learned that Fairfax would be shutting down, came to Houston to see if we could entice people in Houston to want to have a financial advisor with their headquarters in McLean. I was one of the first that they found, so I was working at ExxonMobil Chemical at the time. When I retired from ExxonMobil Chemical, they invited me to join the team. And I said no, and my wife said yes, and here I am. Of course, with the campus in the Woodlands, we have to have a presence in the Woodlands. So today, McLean is still the biggest office, Woodlands second largest. And sometimes I feel lonely out here in West Houston, but most of the time I'm with clients and just loving my location. So what makes Bogart Wealth different from just every other financial advisor? Well, first, our mission statement is to help clients achieve a financial peace of mind by preserving and maximizing intergenerational wealth. So you're a client, your children need advice, we're here for your children. Your parents need advice, or you need advice about your parents. We're here to support you in all of those ways. As independent financial advisors, as being able to do in-house tax optimization, tax preparation, already mentioned those. We can help you with your lump sum versus annuity analysis. We can help you with your estate planning and your multi-generational planning, etc. Our not so hidden objective to do these informational webinars is to convince you you really do want to sit down, have a one-to-one financial strategy discussion with us. No charge, no obligation. I'll say a little more at the end about that, but let's move on. This session today is one of a series of preparing people to be ready for retirement. The one we've been doing for the longest is retirement planning timelines. It goes through what do you need to do if you got 5 years before retirement, you're within 1 year of retirement, or very early in retirement, what are the decisions and actions you have to take. Covers every topic having to do with retirement about 1 inch deep. So all the rest of these then dive down into the details of retirement. So income planning is a big one. I love doing this one. Social Security planning, very important. Understanding taxes, tax laws, especially as they're changing, estate planning, NUA, net unrealized appreciation, and other post-retirement strategies, long-term care, then Roth versus traditional 401ks and IRAs. So this one is really very important for even the younger folks who are trying to decide whether the money should go into a Roth or traditional 401k. And then Roth conversions, backdoor Roth conversion and mega backdoor Roth conversion. So on to today's topic, which is how do the discount rates affect my ExxonMobil lump sum? If you came in a little late, I said, if you're not from ExxonMobil, don't leave yet, because we're going to focus on ExxonMobil lump sum that has some unique properties, but most of what we're going to talk about is pretty generic stuff. Will apply to anybody whose company offers a lump sum pension option. So the first thing to understand is that there are two groups of people: those who are covered by the Pension Protection Act of 2006 and those who are grandfathered from the Pension Protection Act of 2006. So it was passed in 2006, became effective in 2007, and they allowed a 5-year period before everybody had to be covered by the law. So that means if you were eligible to retire before the very end of 2012, 5 years later, if you were going to be eligible to retire by 2012, then you're grandfathered from the Pension Protection Act. So we'll talk about that group of people. But for most of you who are here today, I'm going to assume you are not eligible to retire by 2012, and therefore you are covered under the Pension Protection Act of 2006. And I always like to say, it sort of scares me that the government wants to protect me from my pension. But okay, so basically put some limits on companies that are offering a lump sum option. It defines the discount rates to be used. It defines the actuarial table to be used. Some things about non-spousal beneficiaries being able to do rollovers and company match have to be diversified. And so some other minor things, but we're really going to focus on the discount rate and mention the actuarial table. So let's first talk about the people who are grandfathered. So how did things work before the Pension Protection Act of 2006? So the way the company defined being grandfathered is you were over 50 by the end of 2007 and have more than 10 years of service before January 1st, 2008. Now, I worded it differently. I said you're eligible to retire by the end of 2012, okay? 5 years later, 55 and 15, okay. Another way to state it is you were born before 1958 and you were hired before 1998. And a little and that goes at the end of that would be, and you had no break in service. Okay, so for those people that follows the old rules, I was one of those people, it's 95% of the 30-year treasury bond. You use the daily series. I show you here where you can find it. This is the Federal Reserve Economic Database. And this is the daily government security 30 years, okay? You can download those. You average it, every day counts the same. So you don't take the average for each month and then average those three numbers because not every month has the same number of days in it. So every day counts the same. And then you round it to the nearest 1/4%. And that's how you get it. Now, they're also stuck using an old mortality table. Okay. So what's the difference between the 2000 mortality table and the one that's being used by the others? It's about 3 more years of life. Okay. So interest rates using treasury bonds are going to be lower than the interest rates I'll talk about in a minute for the non-grandfathered folks. So the grandfathered folks get a little bonus by having a lower interest rate, but they have less years of life. So we're going to see how those two play out a little bit later. Here's a big picture. So you can see going back to the 1980s that the 30-year treasury bond has been going down, 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 down. Now, of course, yes, we had this financial calamity in 2020, and it really brought things down. And they've come back up a little bit since then. Okay, so we'll see on the next page. The way you actually do this, you take the data from, say, the 4th quarter of 2018, or you take the data from the current quarter, and then it's going to apply to 2 quarters in advance. So what that means is there's always a dead quarter to allow you to make up your mind about, am I going or am I not going? You got a full 3 months that you'll have all the data to be able to make a decision for the following quarter. Now, this is where it might be a little bit different if you're not from ExxonMobil. They might not be averaging quarters. They might be picking 1 month, which is actually a benefit for you because sometimes you get a really wild month and you get to pick that lowest point. But for ExxonMobil, it's average of a quarter. So that would be the average. You calculate 95% of that, and then you round it. So here it rounded down, rounded down, rounded up, rounded up, rounded up. See how it works? And to see how this has worked out recently, the lowest interest rate in history was 1 1/4. When I retired, I got the lowest interest rate in history, but that was like 2. Okay. So it's been better than that since then. It got down to 1 1/4, then popped back up to 1 1/2. 2 is the current number. And we already know for certain that the 4th quarter of this year will be 2 1/4. But it looks like things have come back down a little bit. And very early, we only have 15 days on the calendar or 10 days of market action. Got 54 days to go, and it could go higher or lower. And at this point, you'd have to say it could easily go lower, because round down to 1.75, then the rest of these 54 days need to average 1.97 or less, okay? And if you look at where this ended last Thursday, I haven't updated it since what I had Saturday data, but if it stays where it was last Thursday, this number pops down to 1.75. So that's for the grandfathered people. Probably no grandfathered people in the room. Again, you had to have been born, basically born before 1957 to have been grandfathered. So everybody else who was born 1957 or 1958 or later, or hired 1998 or later, you are subject to the Pension Protection Act. And for you, it's just not that simple. So instead of following one very well-known, easily defined government bond, they're using the corporate yield curve. Well, they're actually using 3 points on the yield curve. So 3 segments, more detail in just a minute. And they're using IRS mortality tables to get updated every year, but the company's not required to use the latest one. They have to update at least once every 10 years. And I assume that takes a little bit of effort on the part of the company to update that table. The last one they updated to was the 2018 table, okay? So the 2018 table's giving about 3 years more life than the 2000 table. So as it says, these are corporate bonds. Corporate bonds are more risky than government bonds. They're always going to be higher yields, and higher yield is bad. I'll show you that in a minute. Longer life, though, is good. So there's an offset between these two things. And I'll talk more about, how that shakes out in just a minute. So that first affected people in 2013. Well, that was 8 years ago. And so it's now affecting just about everybody. Almost all the grandfathered people have retired by now. Okay, so this is sort of how these 3 segments have moved over time. And as far as you go to the IRS and look at the data, their data only goes back to 2013. I'll talk about going back a little further later. But what you can see is that this segment 1, this is the shortest term bonds, and so the lowest interest rate, that it's gone up from 2013 to the end of 2018, and then down since then, with a little bit of a hiccup right there when the world was going crazy in March of 2020, and flattened out here, and it's slowly come up. Segment 2, you might think of these as intermediate term bonds. So this is 6 to 20 year bonds. And what you can see is it just kind of went in almost annual cycles. It did reach a peak here at the end of 2018. It was already coming down before we had the pandemic that brought interest rates way down. And you can see that it was creeping up, creeping up. It shot up here about the time of the last stimulus package, and people were really worried about inflation, but those inflation concerns have kind of quieted out. Maybe not in your mind, but in the investors' minds. So those are the intermediate term bonds. The long-term bonds, about the same shape. Now, there's a difference between the actual data and our modeling of it. So where you can see daylight, and here right in the panic of 2020, you can see we had some daylight between what here is red versus red's the actual data, orange is our is our model. Or here, the dark blue is the actual data, and the lighter blue is our model. And here it's Kelly green versus lime green, and you don't really see any daylight in any of those. So we do really well on the short term. Sometimes, like here, they had the interest rate going up and we said it was going down. That was the worst month ever for our ability to predict. But by and large, we do a pretty good job. We're within a few basis points of predicting where things are going. So same story about that dead quarter. So here, for example, in the current quarter, this data will cause what discount rate is going to be applied in the first quarter of next year. Okay. The fourth quarter of this year just became final yesterday. The numbers just got published by the IRS yesterday for June. And so then we can do the average and come up with what the numbers are for the fourth quarter. So this one we now know. And what you can see is the fourth quarter compared to the third quarter. We like to compare these equivalent rates because it's kind of hard to see like this went up, this went up, this went down, and how much is each one actually going to play in. So we back calculate these single equivalent rates to make it easier to compare one quarter with the next. And what we're saying is if you're 60 years old, it makes no difference, third quarter versus fourth. If you're 55, you're actually a little bit better off to wait from the first quarter, from the third quarter to the fourth quarter to take your benefit. Now, this first quarter is just a projection. And really at this point, it's a wild guess. So why do I say that? Well, we're only 2 weeks into the quarter. And not only that, but the first month of the quarter doesn't count in making the average for the quarter. It's only the second and third month of the quarter get averaged together to create that quarter, not that quarter, but 2 quarters hence discount rate. So we had to wait for June. And by the time we got to June, well, for sure, April doesn't matter at all. So the only thing we can say about the first quarter next year so far is it's looking good that it's going to be lower. So it went up 42 to 43 basis points from the second quarter to the third quarter. That's history. And we now know that basically from the third quarter to the fourth quarter, it's going to be somewhere between it doesn't matter and 3 basis points. Okay, which doesn't sound like a lot, but we'll come back to in a couple of more slides. Well, just how much money is that, Pete? And then very early indication that the first quarter of next year versus the fourth quarter of this year is going to be down substantially. Not as much as it went up here, but down substantially. And of course, we got 2 more months to go, so we really don't know. But the early indication is positive. Okay, I'm going to explain how I get these single equivalent rates, but assume that I know how to do them. This shows you going back to 1997, kind of what the trend is on those single equivalent rates. One thing you'll notice is corporate bonds are a lot more jumpy than government bonds. So if you remember 2008, we had a financial crisis and it was caused by toxic bonds. Okay, so people not really understanding the bond market all that well, they didn't want any bonds. So corporate bond interest rates had to go really high to entice anybody to buy one. And the same kind of thing happened for 1 month in 2020 when people were just selling anything. But this all gets averaged out into 3-month chunks. So I've explained all this sort of background to you, and you still are like, yeah, but you haven't told me how the discount rate actually affects my lump sum. Well, this is the slide for you. This is the slide you've been waiting for. And again, I've got question and answer open. I've got chat open. So if I'm saying stuff that's going too fast or doesn't make sense, just pop me a question. So I'm going to illustrate for someone who's retiring this quarter. And I'm going to pick them being age 60, and we'll come back to somebody who's younger in just a minute. So we know this quarter that segment 1 is 0.6% or 60 basis points. Segment 2 is 2.73%. Segment 3 is 3.57%. And let's just say this person has a monthly annuity of $4,797.57, which works out to $57,571 per year. And I picked those odd numbers so that my calculation would give a nice even $1 million lump sum. Okay. So first of all, I want to say this is a simplified example to illustrate impact of age, life expectancy, and interest rates. Okay, it can be off by 1% in the actual lump sum. Now, 1% error in $1 million is $10,000, and you'd rather have that 10,000 than lose that 10,000. But bear with me that this is a lot simpler than the way it's actually done. It gets really close to the right answer and illustrates the impact of age, life expectancy, and interest rates. So this person retires at age 60. For that year, they're getting their 57.1, and the company's applying this 6% interest rate. So basically, there's a discount factor applied in calculating the lump sum, and that year's present value, 57,227. Now let me jump way down here to 10 years later. And what the question that is being asked here to calculate this present value is, how much would you have to invest today at a 2.73 interest rate, guaranteed, to be able to pay out 57,571 10 years from now? Okay, so the way you calculate that discount factor is by taking 1 divided by 1 plus 2.73% to the 10th power. So there's a lot of people who would say, the heck with that 10th power thing. I really don't like to use those functions. What I like to do is take last year's discount rate and divide it by, like in this case, 1 plus 0.6%, or in this case, take last year's and divide it by 1 plus 2.73%. And that works, except that doesn't work in year 6. So when we switch from the short-term bond rate, the 5 years in here, 5-year, 1 to 5 year bond, to the 6-year bond, we're assuming for the 6-year bond that you invested this money for all 6 years at this rate. Okay, so if you're used to doing discount factors, but you're used to doing that simplified method, forget your simplified method. You're going to have to do power law to get the right answer and use the same formula every year. Okay, that's kind of for you Excel geeks. For the rest of you, you just like forget what I just said. So this is the table. If the person's life expectancy is 84, they're going to die on their 84th birthday. So they're going to get the dollars for age 83 and no more. Okay, so basically you take the annuity amount, multiply it by the discount factor, get the present value. You do that every one of these years. You use the short-term rate for the first 5 years, use the segment 2 or the intermediate bonds for the next 15 years, and everything after 20 years and after is going to be at segment 3. So you can see out here, as they're getting close to the end of this, 25 years out from retirement, that this discount factor is giving you less than half. All right. You add all those up, it gives you your $1 million lump sum. That's how it works. Now, the single equivalent rate would be the internal rate of return for that cash flow. What? Well, it's sort of like you bought the annuity for $1 million. Okay, so let me go to the next slide. How do we calculate the single equivalent rate? So your cash flow says in year 0, you put in $1 million and you got out 57,571 for 24 years. Okay, you put that into Excel, you can define that range right there, and you take the IRR of that range, it'll tell you 2.77. Or another way to do it would be you put in an interest rate here, and then you make all the other interest rates equal to it, and you use goal-seek method. So that's under the data, what if, goal-seek, to set the present value to find the interest rate that will give you the correct present value that you got doing the other method. And for initial guess, I would always use segment 2. That would be my initial guess. And when you run the goal-seek, it should give you that same number that the internal rate of return gave you. Or there's a mistake somewhere in your formulas. So that's how we calculate that single equivalent rate. And the reason we do the single equivalent rate again is so that we can have one rate to compare quarter to quarter and sort of see how things go. So if we know that in this quarter, the grandfathered people in this quarter have a 2.0 discount rate, and their same number applies every year for their life expectancy, then we know the 2.77 is a higher number. That's worse. But how much worse? And why is it that I have different single equivalent rates for age 60 versus 55? Well, let's go back to this table and say, what happens if the person retires and takes the benefit at age 55? Because you know you can retire and delay taking your benefit. And I'm going to come back and talk about that in a minute. But let's just say we wanted to set up this table for someone age 55. Well, you know, this is 55, 56, 57. And it has 5 more rows to it if we assume their life expectancy is still 84. It's not quite, okay? It's going to be slightly less than 84 if they're 55. But forget that for now. Forget that for now. You've got 5 more years out of what was a base of 24 years, okay? That's a little bit over 20% more years. However, those years are the highly discounted years because they come at the end, okay? You're still going to have the low interest rate for the first 5 years, but in their case, that's the years 55 to 59. And then you're going to have this intermediate term for the next 15 years, but in their case, it's now 60 to 74, and it's now beyond that they have the highest discount rate, the segment 3, okay? So those are worth less than half of the years at the beginning. And therefore, instead of it being 20% more years, let's call it 10% more years. All right. So that's why there's a difference between the single equivalent rate for somebody who's 55. They're going to have more exposure to segment 3 than the person who's 60 and has only a small exposure to segment 3. Again, I want to point out, this is really just a simplified example. It's going to get you really, really, really close to the right answer of exactly how much does this affect my annuity, but it's not going to get you to the penny. In fact, it can be off by, if it's $1 million, it can be off by $10,000. That's important. 10,000 bucks is important, but still, if it's telling you that the value of it is 100,000, you go, yeah, even if it's only 90, that's important to me. Okay, but we'll get back to that in just a minute. Okay, so now the impact on the lump sum. So we're going back to the person who's 60 years old. They had that $1 million lump sum under the conditions that we stated before. And so now we're going to increase their single equivalent rate, or decrease in this case, their single equivalent rate by 1 basis point, 3 basis points, 5 basis points, 10, all the way up to a 1% change in discount rate. And you can see that as you decrease the interest rate, the lump sum's going up, and it would play the same game, but increase the interest rate and the lump sum goes down. So my rule of thumb, I've had this rule of thumb since 2007. So when the 2006 law came out and I was looking at it as an ExxonMobil employee, thinking about retiring someday, and I was saying, now, how much of a difference is that? And I came up with a 1% change in interest rate is a 10% change in lump sum. I never imagined interest rates this low. They were a lot higher back then. But okay, a 1% change here gave us an 11% change in the lump sum. It's pretty close. Here, a 1% increase was a 9.5% decrease. So it's pretty close. And I assume it's, 1% interest rate, 10% lump sum, and then it's linear within the first 1%. So a 0.5% change. No, that's wrong. That's got to be a 5% change in the lump sum. All right, I got to fix these slides. Oh no, that's not, okay, that's not a 0.5%. That's a 0.5%. It's 5% change. That's 5 basis points, and it's a 0.5% change. Yeah, that's right. So even a few basis points has some significance, but to have a big significance, you got to be getting up in that neighborhood of 0.25%. That would be 0.25% would be $25,000 on $1 million lump sum. That would be more like $100,000 on $1 million lump sum. Okay. Hope I didn't lose anybody there. But again, if you have questions, shoot them at any time. So, okay, I mentioned before that if you're not yet 60 and you retire, you can delay taking lump sum. Well, you can delay if you're 60 as well. But it's much more obvious why you might wait if you're not yet 60. Well, maybe it's not obvious. So let me talk about that for a minute. So, you should know that to get 100% of your vested pension benefit, you have to wait till age 60 as a retiree. As a terminee, you have to wait till 65. So that's why achieving retiree status, 55 and 15, is so important. But once you've achieved retiree status, you now can get 100% of your vested benefit at age 60. And you know that if you take it before that, that there's a 5% per year haircut. right? Everybody seems to know that. 5% per year prior to age 60. And it's actually 0.5% per month. So every month counts. But that is stated as the annuity, not the lump sum. Okay? So there's still a benefit to delaying the lump sum, but it's not 5% a year. It works out to about 3% a year. So remember before I explained that if you retire earlier, you're going to get more years. You retire and take the benefit earlier, you're going to get more years of payments. Okay, so again, if we compare 55 to 60, instead of getting 100% of your vested benefit, you get 75% of your vested benefit at age 55. But instead of getting it for 24 years, you're going to get it for 29 years, approximately. So I said, well, those extra 5 years aren't really 20% more. They're really only like 10% more. So instead of the lump sum being 25% less, it's actually only 15% less. So the benefit for waiting is not 5% a year, it's 3% a year. And 3% a year improvement can be wiped out by a 0.25% raise in the discount rate. So this is why a whole bunch of people took their benefit on June 1st, seeing that interest rates were going to jump up 40 basis points, let's just call it 0.5%. They were going to lose about 2 years of waiting. So they jumped. Okay. But that's a quick overview of, so why would you consider retiring now and delaying the lump sum? Well, first of all, it would be, I don't need the money right away. And if you're taking the lump sum and rolling it over to an IRA, I hope you don't need the money right away, because there's a 10% tax penalty for withdrawals from an IRA prior to age 59 and a half. Now, if that's an issue for you, we can explain how to get around that. But for a whole lot of people, they're retiring before 59 and a half, and they have other money to live on to get to 59 and a half, so they don't need the money right away. And as I just was explaining, that when you retire and take the benefit before age 60, there's that haircut off of the 100% vested benefit. And then particularly if you're taking the lump sum, you expect interest rates to fall. So a whole lot of folks, took that package at the end of last year, or, left early this year, but delayed their benefit because interest rates, they weren't still falling, but they weren't really rising that fast either. So they delayed. And then when they saw that jump up between June and July, said, okay, this is the time to take it. So that's kind of the most common waiting game that people play. Now, of course, if you're taking the annuity instead of the lump sum, again, if you don't need the money right away, you are getting 5% more per year by delaying the annuity. So we have some clients who take the annuity and they have other money to live on, and they can wait till age 60 to take it. Then generally we say, if you can afford to do it, do it. It's a guaranteed 5% versus, money at risk. Okay. Not getting any questions yet. Okay, what if you do a split? Yeah, so that's really tough. So let's say that you're thinking about doing 50% annuity, 50% lump sum. And I already told you it's kind of a no-brainer almost. If you can afford to wait on the annuity, you wait to age 60. And it's almost a no-brainer that if you're doing the lump sum, that you're going to play the waiting game with interest rates and take it when interest rates jump up. So, yeah, what I would say, my friend, with that question is let's talk about it. Let's model it for your particular case and see what's best to do. I'll tell you a story though of a couple, and they were thinking about 50% lump sum, 50% annuity. And the way we end up splitting the baby is one of you takes the lump sum 100% and one of you takes the annuity 100%. That makes it a lot easier to make this decision about when to take them. Okay, so another question came in, and I know I didn't do a great job on that. What if you're taking a split? I did the best I can, and the best I can is let's run the numbers for you. So if you're using the ExxonMobil pension calculator, does the formula calculate the 5% per year haircut when you put in a retirement date, a benefit commencement date before age 60? So it does exactly what I described. Now, let me re-describe what I described. When it's calculating the annuity, it uses the 5% per year, okay, or 5/12% per month. And benefit commencement dates are always the first day of a month. And by the way, another thing that people get confused all the time is you're 55 on the first day of the month in which you turn 55. Okay, so a lot of people would think if my birthday is the 15th of the month, well, let's just say 15th of July, that I don't qualify for that until the first day of the next month. No, it's the first day of the month in which you reach that birthday. Okay, so it's going to calculate your annuity, 1.6% times years of service to 4 decimal points, which if you think about that, that means it's what hour of the day you joined, but I really don't think they do it that way. So 1.6% times years of service times pensionable pay, which is the last 36 months of pay. That is the benefit. Then you subtract the Social Security offset. The concept of the Social Security offset is you paid into Social Security your whole working life. The company paid exactly the same amount. They want their half back. Okay. Now, if you didn't work about 35 years, well, they can't get all of their half back because Social Security is calculated over a 35-year history. So they want their half back based on the Social Security that you will get at the earliest possible date you can get it. So if you're retiring at, say, 60, your earliest possible 62. So they're using your age 62 Social Security. Okay. So you subtract off their half or their fraction of their half from that 1.6 times years of service times pensionable pay, you get your vested benefit. Now, to figure out what you're going to get paid, now you take a fraction of that based on your age relative to 60. Okay, that's the 5% per year. Now, from that annuity, you go to that table that I was showing before and calculate the lump sum. Okay, and so they're not applying a 3% discount to the lump sum. I'm just telling you that's how it's going to work out, that the 5% translates into a 3% because the younger you take the benefit, the more payments you get. So it's still a benefit to wait, but it's not 5% a year when you look at it on the lump sum. Okay, so got another question here. What if you're not yet 55 years old and a corporation offers you the option to take your pension as a lump sum without a penalty? Should you take the lump sum, enroll to an IRA when you go to work for another company? So, for example, say that you're 40 years old and have only 10 years of service. So, you know, this is really tough. Before this year, 2021, the company would occasionally offer to sort of buy someone out. Here's your once in a lifetime offer for a lump sum. And I would work the numbers and show the person what a rotten deal it was and how they were much better off to wait till 65 and get their undiscounted annuity. But this year, they've done some surprising things to make the deal look a lot better, okay? And so what they did, instead of discounting it, which the discount, by the way, is instead of 5% a year, real simple to understand for the person who's retirement eligible, it's 10% the first year, 9 the next, 8 the next, 7 the next, like that, off of a base of 65, okay? That is the published table for terminee versus retiree early commencement penalty. So it's huge, it's ugly, and they would take that and calculate the lump sum. From that, it's crappy, you wouldn't want to do it. But what they're doing now is they're taking the undiscounted, yes, undiscounted, but at age 65. Okay, so what that means is they're pretending like you're 65 today and taking a lump sum. So you got a lot shorter life left at age 65, but it still works out to be a reasonable deal relative to waiting to 65 and taking an annuity. And so, yes, by and large, and I can't think of any exception to this, we've been recommending to people to take that lump sum. It's a much, much, much better deal. Now, the question would be, should you roll it to an IRA or should you roll it to a 401, roll it to Voya, roll it to your 401k, and then potentially at another company, you can roll all of that into their 401k. That's where it's tough. And if you already know who the other company is, well, then you can look at their 401k and see, is that a good place to park this? A lot of times 401ks stink. They're set up for the benefit of the financial advisor. I know what I just said would be patently illegal, but somehow they get around it. And so, you know, it's like, I would not roll it to the 401k unless I knew where it was going next. I would roll to an IRA. But again, the downside of that being an IRA, 10% penalty for early withdrawals, same thing in a 401k. There are exceptions. There are fewer exceptions for an IRA than there are for 401k. So again, it's going to come down to the individual situation, and really happy to walk you through all of the pro con of doing this versus that with it, or wait until 65 and taking the annuity. Okay, no more questions for the moment. So the next thing we're showing here is, well, let's assume that you're actually thinking about retiring. How soon should you do what? We have this nice colorful version. I'm an engineer. I like this version of it. I'm going to use this version. So this is written with the idea in mind. Somebody is going to take a benefit commencement date, BCD, of January 1, 2022. Okay, so they want their check to show up right around January 1, 2022. There's no mail delivery that day. It's more likely to show up early than late. But then again, the Postal Service has gotten so bad in the last few years. So, okay. So the company says you should request your benefit, not your benefit, your intent to retire package 90 to 120 days out. So they won't accept your request if you ask more than 120 days prior to the BCD. So there's two parts to it. One part is requesting that intent to retire package. And the other part is informing your supervisor in writing of these key dates, your last day on the payroll, your first day of retirement, and your benefit commencement date. Now, why they ask for all three of those, I don't have any idea. Because your first day of retirement is always one day after your last day on the payroll. How could it be any different? But I think maybe they want you to state that so that you realize that your benefit commencement date cannot come before your first day of retirement. I think that's the reason why they ask for all three, but I'm not sure. So some people will request this package and wait to inform their supervisor. And it used to be that your supervisor wouldn't know, but it doesn't happen anymore. So now when you request the package, they tell your supervisor that you requested the package. So there's no point in waiting. Or you go and talk to your supervisor and say, look, I requested the package, but I'm not sure. Okay. Because this is the one that actually drives your official retirement from the company. So it has to be in writing, it doesn't have to be very formal, it can be an email. And at that point, your supervisor then directs the Tiger timekeeper to start the smart form for your retirement. And you know, when I worked at ExxonMobil, we said one of our products is managers. We create managers, and some of them are off spec. So don't assume your supervisor knows that they're supposed to inform the timekeeper. So I always suggest to people that you copy your timekeeper in this note to your supervisor in which you tell them these key dates and request that they instruct the timekeeper to start the smart form. Okay. Used to take 4 to 7 weeks to get that package, but some miracle occurred early in 2021, and they're now getting that package to you generally within 1 week, sometimes within a day. What might slow it down is if you've been divorced, and in your divorce decree, there's a qualified domestic relations order, which is typically called a quadro. You should already know that if that's the case, but that could slow it down because they use a third-party law firm to review your quadro. And even if you've already given HR a copy of your divorce decree, they've lost it. They will make a charade of looking for it in Curitiba. They will not find it. So make sure you've got a copy of your divorce decree handy to be able to supply that to HR if this applies to you, whether you have a quadro or not. Okay, so you're going to receive this intent to retire package. You know, really, this is more like September 4th, not 24th. So as I explained, it used to be 3 to 7 weeks. You receive the package. You want to meet with your financial advisor to review that package. It needs to be notarized. Depending on if you have a supplemental and additional payments plan, a blah, 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 whether you're married or single, the number of notarizations varies. But basically, you're going to have decision to take the lump sum or the annuity or fractions. And then if you're taking some portions of the lump sum, where do you want it to go? And, you know, basically, you can take cash. That's a big tax hit. You can roll to an IRA. You can roll to a 401k. Okay, and then you have to have it in 35 days before the benefit commencement date. 30 of those are required by federal law. The extra 5 days, let's be kind and say it's because if there's something simple that can be corrected in those couple of days, it can save you from having to do it all over again. But okay. The other thing is to make sure you go on the benefits website and change how your medical plan payments are going to come out. So then basically you're going to get the lump sum. It's going to be delivered to you by paper mail. And somehow you have to get that to where you want it to go. The custodian of your IRA, the 401k, et cetera. We're happy to help you with that, obviously. And then the rest of this deals with rolling out of the savings plan. It assumes you do it right away. Most people do it right away, but not everyone does it right away. So again, it all depends on your situation. So I'm not even going to cover the rolling out of the savings plan today. So what should you do now? You should have a plan. And the most important part of the plan is the budget and understanding what your cash flow needs are going to be. The younger you are, the further from 59 and a half you are, the more important this cash flow detail is going to be. And then understand your long-term investment risk profile. Those are the things to really work on now. Again, we really would love to help you with all of that. We'd really like to, help you understand how your numbers come out, and how changes in interest rate would affect you personally. So, okay. If you want to find this in the future or any of our other topics online, you can go to bogartwealth.com. You can click on that events, and then under that video events, or you can just type in video events. It'll take you to this page. You'll find all the old recordings. If you want to subscribe to get notified of the new ones coming, it's over here on the right-hand side. We're not even asking for your phone number. So, nobody's going to bug you. And I see one more question. Let me get to that in just a minute. The other option is you go to the contact us. Now here, we're actually going to ask for the phone number. But, if we just say down here, just requires email, you're not going to get anybody calling you. Don't worry about it. So what might you be putting down here is, I would like to be on your email for updates to these interest rate projections. We update them every week, and James sends out an email every week as soon as he has the updated numbers from us, and sends that out to the universe of people who've asked for it. You don't have to be an ExxonMobil employee to ask for it. Okay, so the next question is, do I expect ExxonMobil to grandfather the pension plan at some date in the future, and just say that, okay, it's all 401k from now on, because most corporations have done that. If you go back to 1972, why did I pick that date? So that was the first big pension reform legislation that came out in 1972. Prior to that, about 75% of corporations had a pension plan, and there was no such thing as a 401k. Since 72, the number of pension plans has gone down almost every year, and it's down below 25% that have pension plans today. But almost everybody has a 401k. So if ExxonMobil had no pension plan at all, they would be non-competitive relative to Shell, BP, Chevron, Phillips 66. The list goes on. So I do not expect ExxonMobil to make that step. What I would say, if they're going to do anything, they would do what BP and Shell have done, and that is change it from a defined benefit plan to a defined contribution plan. And trust me, that's a lot less beneficial for somebody who's worked there for a career, but it's more beneficial for people who are going to end up leaving at 40. So if they do anything, that would be the change that I would expect. Now, what have these other people done for people who've been around under the legacy plan? They grandfathered them. So there's still people, fewer and fewer every year, retiring from Shell or BP, who are still getting the defined benefit plan, or having an option to take one or the other. So that would be a much more likely scenario. we talk to a lot of people in ExxonMobil every day. We generally hear hints about these things long before they happen. Haven't heard a hint of that, have not heard a hint, but that doesn't mean anything. It could mean that they're keeping it all in Dallas and ain't nobody hearing about it. So yeah, that could happen, but I wouldn't think they would basically get rid of it and go to just the 401k. It'd be non-competitive, my opinion. Okay, I'm a little over my time. I think I've hit all the questions. Let me say, yes, once again, our unhidden motive here is to get you to talk to us one-on-one. Here's some emails and phone numbers. I'll leave this one up. And again, you can find this on our website if you want to come back at a later date and check out anything that I saw. You can also request a PDF of this deck. And you can write to me, you can write to any one of us, and we'll be happy to help you out with it. Or you can go to the website and sign up. Thank you. Hope to see you again at a future webinar.